So foreign exchange. Why is foreign exchange of interest? For that one, a little exercise straight off the bat. So I looked up these share price indices, Dow Jones Industrial, the All Ordinaries, for the last 5 years. So both of them are for the same time span. And first task for you is, if you start with $100 in the very beginning here, which one gives you the better return? And the easiest way to calculate that, I reckon, is just calculate the percentage return overall from the starting point to the end point, roughly. You don't need to have a 100% exact number because the starting number here are not that exactly to see. If you invest $100 in the Dow Jones Industrial, to which amount will it grow within 5 years, according to these numbers up there? Or say it slightly different, by how much in percentage did it grow? I mean, the 19,251 is 5 years. The value of the Dow Jones shares increased from 12,000 to 19,000. 60%, thank you very much. So Dow Jones up by 60% in 5 years. What's the number for the All Ordinaries? 30%, very good. So everybody on board? 60%, 30%. When I was going around, some people suggested 18% and or 0.818% and 0.89%. That is a change for one single day. That is from yesterday till today, not for the 5 years. So which one is better, Dow Jones or All Ordinaries? Dow Jones way better. But what might we have forgotten? If you're an Australian investor and you want to invest in the Dow Jones, you have to switch currencies. And if you bring your money back, so you have to buy US dollars to invest in the US. If you bring your money back, you have to switch back currency from US dollars to Australian dollars. Do you know which exchange rates you get over 5 years? Do they stay constant? No, they can change. So there's massive foreign exchange rate risk, and that's exactly the topic that we do today, and that's the reason why I put up that exercise. So if you invest in different countries, you always have to be aware of foreign exchange rates, and they can change. So there's lots of risk. We have foreign exchange quotations. So I think all of you have seen foreign exchange rates beforehand. Currently it's, for example, 0.77 roughly for Australian dollar, US dollar. But there's two different ways of quoting exchange rate. There's a so-called direct quotation, also called price quotation, and indirect quotation, quantity quotation. They're just the flip side of each other. Let's say, for example, 1 Australian dollar can buy 2 Argentinian pesos. Totally unrealistic, but just to have it quick. So they can say 1 Australian dollar buys 2 Argentinian pesos, or you could also say 1 Argentinian peso is buying, so half, 0.5 Australian dollars. So 2.5 in that sense is the same thing, it's just the flip side. And these are the two different quotations. But I have lots of exclamation marks here because it's very easy to mix up. And also, unfortunately, I think what we do in this class is the exact opposite of what you do in lots of macro and other classes. We do use the indirect quotation, the quantity quotation. You will see me getting sometimes a little bit slow during today's lecture because in Europe we use always a price quotation, and I grew up on the price quotation for 10 years, so it's still a bit awkward for me to think in indirect quotations. But that's what we will use in this class. We will always use the indirect quotation, and that's not tricky enough. The way they quote it on the internet and the newspapers. So they usually say Australian dollar, US dollar, meaning 1 Australian dollar is buying so many US dollars. Or Australian dollar, semicolon, US dollars, same thing. Here too, same thing, same thing. But now watch out. What does this one mean? Australian dollar slash US dollars. Especially people that haven't had finance. If you have to guess, does this mean 1 Australian dollar, so many US dollars? Or how many Australian dollars you can get per US dollar? No, 1 Australian dollar and you get so and so many US dollars, which is the right answer, right? So this is the unfortunate one. It looks like a divided sign, but it's not a divided sign in this context. But in some publications, I've come across one from the IMF, for example, it means divided sign. So even though different publications are writing the same thing here, they write a different exchange rate to it. Some of them write 0.77 next to it, and the other one write 1.44 or something next to it. So it's really messy, and you can't be careful enough. In this class, the one that comes first is the one with 1. That's what we want to remember here. Example, so you can see the exchange rate is a bit older. So here we have 1 Australian dollar is buying 95 US dollar cents. And we can flip it around. So 1 US dollar is buying, therefore, a little bit more than 1 Australian dollar. In the book, they talk about commodity and terms currency. I don't like it that much. If you remember this, the first one is a 1 and the other one is X. That's the trick here. Then also we use the terms appreciation and depreciation, which you hopefully have heard in macroeconomics before already, right? I just want to say quickly why we don't like to talk about up and down. So these are kind of the same exchange rates. That's one time I used the indirect quotation, and here I use the direct quotation. So here it's 1 Australian dollar is buying so many US, and here it's 1 US dollar buys so many Australian dollar. Just the exact flip side. And you can see it too here in the graph. So of course, if this one goes up, this one goes down by the same amount. If this one goes down, this one is going up. So it's the exact mirror image. But now you can see why it's not good to talk about up and down. If I'm saying the Australian dollar went up, well, that's true if I talk about this way of quoting the currency. But here, it's going down, and it means the same thing. That's the reason why we don't want to use up and down when we talk about exchange rates. When we talk about exchange rate, you should always use appreciation and depreciation. And the definition here is basically, I might have skipped it. So if a currency is appreciating, it's gaining value. That's the trick. So either you can get more of the other currency for your home currency, or you have to pay less of your home currency to buy the foreign currency. It means the same thing. But your currency is gaining value. That's the important one. Depreciation, your currency is losing value. Good, so I never want to see up and down when we talk about exchange rates. Foreign exchange quotations, so similar to the buyer and seller, here we have bid and ask. And again, they can be quite messy very quickly. So rule of thumb here is always the dealer always wins. So the dealer is basically the one that you do business with at the bank. So if they're selling you, for example, US dollars, they're going to sell them to you cheaply or expensive? Expensive. And if they're buying US dollars from you, cheap. So that's the rule of thumb here. So let's see what that means. Here's 1 Australian dollar is getting us so and so many US dollars. If you want to buy US dollars, you're traveling to the US. Which one do you look at the bid or the ask? Said the dealer always wins. You put Australian dollars on the table and you want to get US dollars for it as a customer. The dealer is giving you lots of US dollars or little? Little. Which one is the little number? Ask or bid? Bid. Yes, wonderful. Right? You study economics? Yes. So economists like to think in prices. That's why economists love the price quotation. But unfortunately, in this class and in financial markets, they use the quantity quotation. So they're not telling us how much we are paying. They're telling us how much we are getting in return for a $1 payment. So everything that is in your head, because we like to think in prices as economists, and I've got the same problem as you, is flipped upside down. And always with foreign exchange, you can't be carefully enough. Take a deep breath and think it all the way through. Whilst I was asking you, I was scratching my head myself too, because it's so easy to mix it up. You have to think and think practically, literally. Maybe take a piece of paper out, put it on the table, or think it in your head. You're going to speak to the dealer, and these exchange rates are $1. If I want to buy US dollars, that means I put $1 on the table. How much US dollars do I get for it? And you want to pick the low number now, right? Because the dealer always wins. He's not giving you a lot, he's giving you a little. Or you can try memorizing it, but as I always say, I don't like memorizing. Exam stress, you mix it up. Nice and calm here. What do we have here? $1 Australian is buying this number of New Zealand dollars first, and now next day, for example, it's buying more New Zealand dollars. That means the Australian dollar gained or lost in value? Gained in value. And that automatically means that the New Zealand dollar depreciated. Thank you very much. That's even better than gaining and losing. So the Australian dollar appreciated and the New Zealand dollar depreciated. Bid offer we already had. Midpoint. Midpoint is basically what we see in the news. They don't tell you the bid and offer rates. They tell you one exchange rate, which is basically the middle out of the two. That doesn't mean that if you go to the bank, you get it at that exchange rate. The bank or the dealers, they always make a spread between buying and selling, and the difference they pocket because they want to make a living too. Okay, an example. Okay, this is from the dealer's point of view. Counterparty is basically us. So we want to buy Australian dollars. Now it's getting even messier because now it's flipped twice in our head. So we have to think, well, if you're buying Australian dollars, if we are buying Australian dollars, we are buying the Australian dollars from the dealer. That means the dealer is selling Australian dollars to us. And that's giving us a good starting point. Because he's selling the Australian dollars to us cheaply or expensive? Expensive. So we have to pay a lot of New Zealand dollars to buy our Australian dollars. Because he's charging us a lot in the other currency, of course. And that means we take this one here, the offer rate.
Cross rates. So what are cross rates? Cross rates is usually if we have two exchange rates that are not frequently traded, then we can still figure out the cross rate. Just a practical example here. Let's say this DJ from Thailand wants to buy a CD of eBay or wherever from Jamaica. So she needs to pay in Jamaican dollars. And she has, of course, Thai baht. Now, if you think very practical, that means you have to translate your Thai baht into Jamaican dollars. So she has to find somebody who is willing to accept Thai baht in return for Jamaican dollars. And how easy would it be to find somebody like that? How often do banks in Thailand, for example, have Jamaican dollars flying around? I imagine very, very seldom. So certain currencies are simply not frequently traded, and especially not against each other. So I imagine between Australia and Indonesia, there might be quite a lot of currency trading happening, between Australia and New Zealand too, but between these two countries, Thailand and Jamaica, not so much. But of course we still can do it, and the way they simply do it is, well, there's lots of exchange rate trading between Thai baht and US dollars. There's a huge market for that. There's also a huge market for Jamaican dollars against US dollars. So we can simply use Thai baht to buy US dollars first, and then use US dollars to buy the Jamaican dollars. So we will go across another currency. That's the idea here. So that's where the cross rates come from. Also another practical thing, before we had the internet, they had in the newspapers the exchange rate printed out. And you can imagine printing out exchange rate against the major currencies, just like here. Doesn't take too much space. But now if you put up all kinds of currency pairs that you can have, we have, I don't know how many currencies we've got in the world, but clearly over 60 at least. So if we may plot each currency against each other currency, you need a whole book. That would be useless, and the exchange rates change every single day too. So again, what you can simply do is you have the major currencies here, or possibly even all currencies simply against the US dollar, and then you can use the cross rates, calculate them themselves to get all kinds of combinations. Now, how do we do these combinations? Let's keep that to your turn. So I'll give you two exchange rates here. So we have the US dollar. One US dollar is buying 127 Jamaican dollars, and one Thai baht is buying basically 3 US dollar cents. And your job is now to find out the exchange rate between one Thai baht. How many Jamaican dollars do you get for one Thai baht? A little bit of a hint, always think first if the number should get bigger or smaller if you do these kinds of things. So which currency is kind of worth a lot and which currency is worth little, that you're not heading completely in the wrong direction. So I always say make the common sense test first. So the first step is we have Jamaican dollars. So the record is 1,277 Jamaican dollars. And maybe translate it first into US dollars. And then we want to figure out there's two ways. We can either multiply it with 127 or we can divide it by 127. And instead of memorizing something, you want to figure out the number. Should the number get bigger or smaller? So the US dollar is kind of worth more than one Jamaican dollar or less? More. So if the US dollar is worth more, the record in US dollars will cost more or less than 1,000? Less. So that's the first thing you have to figure out. So it's less. So you have two choices. You can multiply it with 127 or you can divide by 127. Since it must be less, the answer should be obvious. And then you continue with the same thing towards the Thai baht. There's actually two things that we can calculate. Sorry for that one. You can calculate either the cross rates, that's what it says here, or you can calculate how much the record costs you in Thai baht, right? Both of them, of course, are related. So you see, this one is US dollar / Jamaican dollar, and this one here is Thai baht / US dollars. Let's pretend this is a divided sign. So if you would multiply this number, US dollar divided by Jamaican dollars, times Thai baht divided by US dollars, the US dollar would cancel out, the Thai baht would go on top of the fraction, and then we would have Thai baht divided by Jamaican dollars. Then you would get straight away towards the cross rate here, which is 3.8316. And now I'm telling you why you could do this. So if we had here the price quotation, then it's quite clear, because then it would really be per Jamaican dollars, per US dollars, and then these things really cancel out. Here the thing is, in the math calculation that I did now, is I pretended this is per Jamaican dollar, this is per US dollar, and this is per Jamaican dollar. So I have all the fractions flipped the wrong way around on the right side of the equation mark. But I also make the same error on the left side of the equation mark, and because I do twice the same error, the math is working out again. So that's the reason why, despite using the quantity quotation here, we can use that simple rule of thumb. We pretend that these are fractions, and we easily get the cross rate such that we multiply them this way so that we get here the right one on top and the right one on the bottom. That's one way. The other way is we do it step by step. So we can flip this one here around and see per US dollar, how much are we getting? So we do 1 over 0.3, then we get the number per US dollars. And here we have 1 US dollar is giving us so many Jamaican dollars, so we multiply this one by that number, and then we get exactly the same number again. In principle, the calculations are very easy. In practice, very easy to make errors here. And you can avoid all these kinds of errors by always thinking first, when you do something about exchange rate, do I have to get a bigger number or do I have to get a smaller number? That's clearly the easiest way to avoid errors here. So do me a favor, always make that check first before you type anything in the calculator.
Foreign exchange contracts, we can either have a spot contract or a forward contract. What we talked about now is a spot contract. And spot contract basically means on the spot, right now. I know all the textbooks, or some of the textbooks says T+2. That just means it takes 2 days to settle. It takes 2 days till you paid your money, transferred it to another bank, blah, blah, blah. Same as if you're buying shares. If you're buying shares now, it basically takes 2 days till you actually get your shares. It's nothing to worry about, in my opinion. It's just a small time delay. Spot means now. The alternative rate is a forward rate. So foreign exchange rates are very volatile, right? What you can see here, up and down, up and down, up and down. I made this for 5 years for exactly the same time as we had our Dow Jones and All Ordinaries index from beforehand. And we can see here, roughly 5 years ago, it was 1 for 1. So 1 Australian dollar bought 1 US dollar, which makes our life nice and easy. So when we start our investment in the US or in Australia, would have been the same dollar amount in both countries. But since then, the exchange rate went this direction, and let's see what that means. The Australian dollar appreciated or depreciated? This is Australian dollar. 1 Australian dollar is buying so many US dollars. Gained in value or lost value, the Australian dollar? Depreciated. Now, what does that mean to our initial investment here? Which is a better investment, investing in the US or investing in Australia? Remember, the US had 60% return, Australia had 30% return. The Dow Jones increased from 100 US dollars to 160 US dollars. And now if you translate 160 US dollars back into Australian dollars at this exchange rate, do you get more than 160 Australian dollars or less? More. So you have to divide it by 0.75. And if you divide it by 0.75, you get 230 Australian dollars. That means 100 Australian dollar investment switched 5 years ago into US dollar, put into the Dow Jones, waited for 5 years, then switched back into Australian dollars, gave you a return of 113%, which is way more than 30% in Australian dollars. And the reason why I said that the economists should struggle with this one, what would you have expected usually? If something is giving you a high return overseas, usually the exchange rate would go the other direction, right? So you usually would expect the real returns all over the world to be roughly the same. Right? Otherwise, things are a bit weird. But in this case, obviously, has not been roughly the same at all. So in this case, the Dow Jones grew faster, and on top of that, the US dollar appreciated versus the Australian dollar. So you get a profit twice. Foreign exchange rate is very volatile, so up and down, up and down, and down. Look at this one, 25%, that's a big jump. Or in between, even for shorter times here, the British pound after the Brexit crashed down quite a lot. So exchange rates, very volatile, hence it's very risky to invest abroad.